While the world was watching holiday headlines, rate cut chatter, and year-end rallies, the real event happened somewhere most people never look, inside the physical settlement lanes that actually move metal. Because on the Western screen, silver still looks orderly. A number updates, a chart prints, a price exists. But in the East, in the market that demands delivery, the price stopped behaving. Shanghai didn't just lift, it broke through. $82.15. Not as a headline, not as a rumor. As a bid that gets filled when someone needs metal that must arrive, on schedule, in size, in reality. And that single print changes the entire phase of the silver market. Not because 82 is a magical number, but because it exposes something far more dangerous. The West is watching a paper reflection. The East is paying for the object. And when those two worlds diverge, you don't get a normal rally, you get a control problem. Tonight, we're going to walk through what this breakout actually means, why the arbitrage bridge is failing mechanically, not philosophically, and why the next 24 to 72 hours matter more than the next 3 months. Because once Shanghai establishes an $80 handle as the delivery truth, the Western screen price becomes what it really is, a discount, a negotiation, a last defended line. And discounts don't survive scarcity. Let's set the rule of the game before we go any further. In surplus markets, paper sets the price because physical is abundant and delivery is assumed. In deficit markets, physical sets the price because delivery becomes the commodity. We are drifting out of surplus logic and into deficit logic. That's the pivot. That's the entire story. When Shanghai prints $82.15, it's not predicting anything. It's not forecasting. It's not posting a vibe. It's accepting a price that reflects urgency. And urgency is a form of information that charts dawn a T capture until it be too late. Now, the first thing we have to do is strip the noise away and look at the spread like engineers, not commentators. If the West is showing, say, $72 to $74 on paper references, and Shanghai is printing $82.15 for physical reality, that gap is not a small divergence. That is a double-digit dislocation. And double-digit dislocations in major commodities do not persist politely. Markets don't tolerate them because someone is supposed to close them. That someone is arbitrage. Arbitrage is not a theory, it's a plumbing system. It is the mechanism that keeps global prices aligned. In a healthy market, if one venue is cheaper, traders buy there, move the product, and sell where it's higher. This pushes the low price up and pulls the high price down until they meet. That's the textbook. So if you're seeing $82.15 in Shanghai and materially lower prints in Western references, you should immediately ask the only question that matters. Why isn't the gap closing? There are only a few answers that can be true, and every one of them is bullish in the way bulls don't even understand. Either 1, the metal cannot move fast enough. 2, the metal cannot be sourced in size at the quoted Western price. 3, the transaction costs and restrictions have risen so high that risk-free arbitrage is no longer risk-free. 4, the settlement assumptions are breaking, meaning cash settlement, delays, or terms changes are becoming normal. All 4 are versions of the same diagnosis. The bridge is failing. And when the bridge fails, the paper price becomes a local price, an internal price, an administrative price, rather than a global price. Now we get to the line in the title. The West is tricked. That's not a moral judgment. It's not a political statement. It's a market structure statement. Because what does the West actually see? Most investors, and even many professionals, see a screen-fed composite built largely around paper contracts. Contracts that can be rolled, netted, swapped, hedged, and ultimately settled without the metal ever changing hands. This system is efficient in surplus. It's efficient when trust is intact and delivery is easy. But when physical tightens, the paper system doesn't instantly transmit scarcity. It transmits liquidity, tradability, velocity, options positioning. It transmits what can be traded, not what must be delivered. So the West is tricked in the same way a thermometer can be tricked if you place it near a heater while the room is freezing. The reading looks calm. The environment is not. Shanghai, on the other hand, is pricing a different thing. Not silver as an asset. Silver as a requirement. Silver as input. Silver as inventory. Silver as production continuity. And when an input becomes uncertain, the behavior of buyers changes completely. They stop optimizing. They start securing. That behavior is what a breakout looks like in the real world. Not a candle, a scramble. Here's what this breakout tells us in plain language. Somewhere, someone paid up aggressively to remove delivery risk. They were not paying for upside. They were paying to avoid failure. This is the difference between speculation and survival. If you want to understand why the $82.15 print matters, you have to understand how small the silver component can be in a finished product, and how catastrophic it is to run out of it. Think about a factory with large contracts, hard deadlines, and penalty clauses. If silver is a small percentage of total cost, then paying 10% more for silver is nothing compared to missing delivery, breaking a contract, or halting a line. That's why industrial demand is not price sensitive in the way people assume. When we're talking about inelastic industrial demand, we're not saying they don't care about price. We were saying the cost of not having it is higher than almost any price they'll be forced to pay in the short term. So if Shanghai prints $82.15, it's because buyers have entered that psychology. They've crossed the line from wait for a dip to secure the supply. And once that line is crossed, you do not get gentle pullbacks. You get step function repricing. Now let's bring the arbitrage math into focus. Assume the Western reference is $72 to $74, and Shanghai is at $82.15. That gap isn't $2 or $3. It's the kind of gap that, in a functioning commodity system, would be harvested instantly by every desk with a pulse. Buy cheap, ship, sell high. Even after transport, insurance, financing, and conversion, the net profit could still be meaningful. And if the market were healthy, the volume of arbitrage would be so large that the act of exploiting it would erase it. But the fact that it persists, or that it can even appear at that scale, means the exploitation is constrained. Constrained by what? By physical availability, by logistics, by settlement terms, by export restrictions, by bar specs, by time. And time is the hidden factor that kills arbitrage, because you can't close a gap today with metal that arrives in 3 weeks. If Shanghai is bidding for delivery now, then 3 weeks is not soon. 3 weeks is failure. So the problem becomes, yes, you can buy silver on paper, but can you buy deliverable silver in the right form, in the right place, in the right time frame? That's the difference between a tradable quote and a real price, and that's where the West gets lulled into complacency. Because paper is always available. Paper is infinite. Paper can be created as long as someone will take the other side. But physical is not created by trading. It's created by mining, refining, and logistics. And those processes do not accelerate because a chart looks bullish. So what we're watching here is not a hype story. It's a constraint story, a throughput story, a bottleneck story. Now, the most dangerous part of this phase is that it doesn't look dangerous until it does. The early signs look like interesting spreads. They look like regional premiums. They look like temporary dislocations. Then suddenly it becomes dealers remove prices, delivery windows extend, wholesale availability tightens, leases spike, margins rise, rules change. And by the time the average investor is emotionally convinced, the repricing is already complete. That is why the timing matters. And that brings us to the trap the market is walking into right now. Thin holiday liquidity, lightly staffed desks, lower depth, fewer market makers willing to warehouse risk. In thin liquidity, prices do not move smoothly. They jump. And when the move is driven by forced buyers, hedgers, market makers, industrial procurement desks, thin liquidity becomes an accelerant. This is how a market goes from elevated to unmanageable in a single session, not because the fundamentals changed in one day, but because the market's ability to absorb the fundamental truth collapsed in one day. Now, let's talk about the West's defense mechanism. When a physical squeeze threatens a paper reference system, the system doesn't immediately admit scarcity. It does what systems always do under stress. It changes terms, it raises friction, it increases the cost of participation, it reduces optionality. This can show up as margin hikes, tighter position limits, temporary rule modifications, additional reporting requirements, changes in delivery incentives, or settlement practices that favor cash. These are not conspiracies. They are predictable stabilizers. But stabilizers don't create metal. They can only slow the speed at which the paper market is forced to reconcile with the physical market. And slowing reconciliation is not the same as avoiding it, because the physical market keeps pulling, factories keep consuming, solar and electronics keep scaling, inventory still drains. So if Shanghai is paying 82.15 and the West tries to defend a lower screen price with administrative friction, the real result is the gap persists longer. The resentment builds. The eventual repricing becomes more violent. Markets can hide reality for a while. They cannot erase it. Now we need to introduce the most underappreciated weapon in this situation, psychology. A large percentage of Western participants have been trained by decades of mean reversion. They expect pullbacks. They expect corrections. They expect the system to normalize. They see rallies as tradable events. They see spikes as opportunities to fade. That works in surplus. It even works in balanced markets. It fails in deficit markets. Because in deficit markets, the pullback is often a paper phenomenon. The physical never actually loosens. The physical just becomes more difficult to source and the premiums rise silently. So the chart can go down while the real-world buyer experiences a higher effective price. This is why the West is tricked is not rhetoric. It is the lived experience of anyone who has tried to source real metal during a physical tightness episode. The paper quote says one thing, the physical invoice says another. Now, let's talk about what happens if Shanghai holds the breakout, because that's the key. One print can be noise, a held level is signal. If Shanghai prints $80.15 and then holds the 80 handle, we have to interpret what that means. It means buyers at that level are not exhausted. It means procurement is not finished. It means the bid is structural, not speculative. And if it is structural, then the West is not late. The West is behind the curve, and markets punish behind the curve conditions with gaps. Not gradual drift, gaps. Now we bring options mechanics into the conversation, not as jargon, but as force. When a market moves through heavily positioned strike zones, market makers may have to hedge dynamically. This can create a feedback loop where buying begets buying. In normal liquidity, this is manageable. In thin liquidity, it becomes reflexive. The market starts moving because it must, not because it wants to. That's how prices leap. Not because everyone suddenly turned bullish, but because the structure forces the system to chase. This is also why the $75 to $80 region, depending on positioning, can behave like a trigger zone. Once crossed, the hedging pressure can turn linear buying into exponential buying. And that matters because if Shanghai is already printing 80 to Dow 15, then the West OS paper market is being dragged toward a region where forced buying mechanics can kick in. If those mechanics kick in while physical is already scarce, the result is not a neat convergence, it's a repricing event. Now, what does a repricing event look like? It looks like a day where silver opens several dollars higher than yesterday's close. It looks like a gap that doesn't fill. It looks like what just happened across every trading desk. And then, only after the move, does the narrative catch up. The narrative always arrives late. Reality arrives first. Now, let's translate this into what viewers actually care about. They care about two things. Are they being shown the real price? What happens next? The honest answer is, the real price is no longer a single number. In this phase, price becomes a spectrum. Paper reference, wholesale physical, retail physical, delivered industrial supply. And those numbers can diverge dramatically. So if you're asking, what's the real price? The answer becomes, the real price is what gets metal delivered in your time frame and your size. Shanghai printing $82.15 is the market shouting that delivery price has moved. Now, what happens next depends on whether the gap narrows or widens. If the gap narrows, there are only two ways it can happen. Either the West gaps up to meet the East, or Shanghai falls back because demand collapses. Demand collapse is unlikely in the short term if the driver is industrial procurement, because industrial demand doesn't collapse overnight. It pauses only when supply certainty returns, and supply certainty does not return quickly in constrained logistics. So the more plausible convergence path is, Western price rises to catch up. And if that happens, it will not be a slow catch-up. It will be a jump, because the West is waking up to a price it did not participate in setting. That is the overnight repricing risk. Now, if the gap widens, the story becomes more severe. A widening gap tells you that not only is the bridge broken, but that demand is accelerating faster than the system can respond. An accelerating demand into constrained supply produces one outcome, rationing. Rationing doesn't always look like no inventory. It often looks like higher premiums, longer delivery times, call for, quote, mandatory minimums. Restrictions on bulk rationing is scarcity wearing a suit. So what should viewers watch if they want to understand whether this is real and whether it is escalating? We recommend 5 signals. Simple, observable, brutally honest. First, Shanghai behavior at the next open. Does it hold the 80 handle and does it defend higher lows? If it holds, demand is not done. Second, Western reaction at the next open. Do Western references gap up or do they try to ignore it? If they ignore it and Shanghai holds, the credibility problem grows. Third, physical premiums in your local market. Not social media, not rumors, quotes. If retail premiums climb while paper stays flat, decoupling is underway. Fourth, dealer availability and delivery windows. If in-stock becomes pre-order and ships in 2 days becomes ships in 3 weeks, the supply chain is tightening. Fifth, volatility with thin depth. Big moves on modest volume are a signature of liquidity vacuum. When depth disappears, prices can move violently with small force. Those 5 signals will tell you if this is stabilizing or snapping. Now here's the part most people misunderstand. Even if the West catches up on paper, the stress does not end, because catching up on paper does not refill vaults. It does not create new inventory. It does not shorten shipping times. It simply acknowledges reality. So if we see the West gap higher, that's not resolution. That's admission. And admissions tend to come late, after the pain. Now let's address the hidden motive question, the one that always surfaces. Why would the West want to keep the price down? You don't need to assume intent to understand effect. In a paper-dominant pricing regime, stability is a product. Lower volatility is a product. Controlled price discovery is a product. A sudden violent repricing in a foundational industrial metal creates hedging losses. margin stress, inventory revaluation, counterparty questions, policy attention. The system prefers smoothness, but smoothness is not always compatible with scarcity. So if Shanghai is forcing price discovery upward, it forces the rest of the system to choose between admit higher prices now or delay admission and risk a larger, more violent adjustment later. History suggests systems choose delay, and that's why breakouts become breakages. Now we come back to the title again. Shanghai Breakout, $82 to $115 is now reality. The word reality matters because it's not describing a chart. It's describing a behavior, paying up for delivery. And if this is truly a delivery-driven phase, then the next question is not, can it go to $90? The next question is, what happens when industrial buyers start treating $82 as normal? Because once a buyer normalizes a price, it stops being a ceiling. It becomes a floor, and floors in deficit markets can rise quickly. That's why the panic tone you're seeing across viral content is not just theatrics. It's the recognition that when physical demand takes control, the market stops obeying the old rules. Now, we need to speak to the viewer who is tempted to do something reckless, because stress narratives can push people into bad decisions. We are not telling anyone to panic buy. We are not telling anyone to lever. We are not telling anyone to gamble on a week. What we are telling you is to stop confusing the screen with the supply chain. The screen shows you a tradable reference. The supply chain tells you whether reality is tightening. And Shanghai printing 82.15 is a supply chain message. Now, let's paint the next 72 hours in a realistic way. No prophecy, just branching logic. If Shanghai holds above $80 and repeats elevated prints, Western participants will be forced into one of two behaviors. Either they chase on paper or they attempt to suppress through liquidity and terms. Chasing can move price violently, especially if options hedging amplifies the move. Suppressing can delay the move, but it intensifies the eventual move because physical does not stop being scarce simply because paper is pushed lower. So either path contains upward pressure. The only thing that changes is the shape of the move, a grind or a snap. And snaps happen when people are off desk, when liquidity is thin, when risk desks are cautious, and when everyone realizes the same truth at the same time. That's why holiday conditions matter. Not because markets are magical on holidays, because depth is fragile on holidays. Now, let S end with the clearest bottom line we can give you. If Shanghai is consistently paying above Western references by a double-digit margin, and if physical premiums remain elevated, the market is telling you one thing. Deliverable silver is tighter than the screen suggests. And if deliverable silver is tighter than the screen suggests, the screen will eventually move. Not because narratives win, because physics wins. Metal either exists where it's needed, when it's needed, in the size it's needed, or it doesn't. And the moment it doesn't, price stops being a number and becomes a rationing tool. That's what you're watching the early stages of. So tonight, don't get hypnotized by the calm Western quote. Watch the bridge, watch the spread, watch the premiums, watch availability, watch delivery windows, watch the behavior of the market that demands the metal, not the market that trades the promise. Because $82.15 in Shanghai is not a headline. It's a warning that the real market has moved. And once the real market moves, the rest of the world doesn't get to vote. It only gets to catch up.